on your money.
Okay, so here we go. Is SoFi effed? Is SoFi effed? Is SoFi... Riley, how about you? Let's get your thoughts. Is SoFi effed? What do you think?
Well, I mean, they do have some relation, but it's very, very small. And then SoFi just earlier today said that it really doesn't affect them at all.
They tweeted. They said, we don't have any issues. They said, stop hitting our lines. We're good. And then Noto bought 180,000 shares to kind of tell shareholders, hey, I believe in the stock. We're fine. Kris, any thoughts on Noto buying shares and basically saying we're good?
I mean, that was right now, every single CEO on Wall Street is trying to come up ways to give confidence to its shareholders and also to its stakeholders, because the last thing you want right now is a run. Okay, SoFi right now, if let's say a third of their members said, you know what, I don't trust my money with SoFi, and they did a bank run right now, SoFi would be out of business like tomorrow morning. Why? Because most of the money that's out there is not liquid cash. It's sitting in personal loans that are out there that SoFi has lent out, okay? That is the problem. The problem isn't these banks are healthy or not. They're healthy banks that actually make money. The problem is they cannot, when you have a bank run, you can't just solve it. You need liquid capital sitting on your balance sheet. And that, like I said, that's a vulnerability for SoFi right now, right? So right now it's all about shoring up as much confidence as possible that, hey, we don't need the money. Hey, we can support withdrawals, and the good thing about SoFi is that they don't have concentration risk like Silicon Valley Bank did. Silicon Valley Bank, I think, had a few thousand accounts. I think maybe like 30, 40,000 accounts that were mainly like companies. So there's a lot of concentration there versus SoFi, who's got millions upon depositors. That's the benefit of being a bank that lends to commercial clients, is that you don't have the concentration risk that you have with dealing with like a large, like, what's the word? Like small clients, but wealthy clients.
Okay. Tannor, why is SoFi not effed?
Well, okay. So a couple different things. So I think it's not just, there's a couple of reasons why Silicon Valley Bank actually crashed. And one of them, like you said, was deposits were coming in 2020 and 2021. They were storing that money in treasuries and in very, very low paying places where they were locked up for a certain period of time. Once they actually tried to sell this, rates were so much higher, so they had to put a near 45% discount on the things that they were selling. So they got crushed just selling the stuff that they had purchased back whenever there was a massive run up. Now, if they could continue that run up with new VC money, then that would have been fine, almost like a Ponzi scheme-esque thing, but they ran out of new clients because that was just the nature of the market in venture capital. The only good startups these days are Audia, and who knows how to invest in that anymore. But whenever we're actually looking at SoFi, the difference is that, one, we don't have a lot of that old term treasuries or anything like this. We're a brand new bank, so we're just starting our portfolio right now. Secondly, no one's running from 3.75% deposits, right? This is the place people are running to. Whenever we actually look at, and I think Kris has seen this sheet, Stephen Fiorillo actually started it, and I'll put it up in the chat here in a second as I bring it up. But whenever we actually look at deposit growth, SVB was one of the lowest ones, along with like New York Bank Mellon or whatever it's called. These types of bank institutions had some of the lowest growths in deposits, like negative 12% for SVB. The opposite is happening for SoFi, where we're seeing like 500% growths just because our portfolio is that new, right? So I think it's a completely different side of the business where this couldn't really happen because we're the people are actually fleeing to, rather than even JP Morgan, Bank of America, Citigroup.
Hold on, Tannor. The reason why SoFi is growing its deposits because the attractive interest rate that SoFi is offering. They're not doing charity work, right? They're not saying, oh yeah, give us your money because you just like us. No, they're giving you a really good rate of return for your money. Now, how are they making that money? Because they have to make money to give you that good rate of return. The way they're doing it is personal loans that are out there that they're charging 11 and 12% interest on. My biggest concern with SoFi has always been around delinquencies. Now, everyone is saying, well, you know what? Delinquency rates are going to be fine. fine because number one, SoFi still lends to only really high FICO score individuals, which is totally cool. Like I get the business model. Originally, they had started this to help finance people like doctors and nurses who may have been in a difficult financial position, but they're still generating a ton of income that they had to refinance their loans and all this other stuff. So that's where they started. And I still do believe if the numbers on their FICO stuff is correct, that SoFi doesn't have anything to worry about. My problem is if delinquencies go up because let's say the economy goes really bad and really sour, how much of those personal loans are they going to have to eat? The loans, the losses on those loans are going to have to eat. That's the biggest vulnerability. And then on top of it, it gets to the point where if SoFi has any trouble paying like their creditors or has to lower their interest rate just to keep their deposits in line, that means that if there's a run on SoFi, then same thing's going to happen. SoFi is going to get hit with a tremendous amount of pressure to sell those assets because they have assets, right? Think about the personal loans that they have. Those are technically assets. They're going to have to sell them. Now, the thing is, when you're in a bad place, no one is going to offer you par value for them. They're all going to say, hey, I'll buy them off your hands for 25 cents, 50 cents on the dollar, which is exactly what's happening with the treasury.
So the way SoFi collapses on this or any type of neobank is not because of Silicon Valley Bank collapsing writ large and that having a ripple effect. Rather is if the ripple effect of SIVB collapsing creates an economic meltdown, not Lehman in 2008, but if it does something similar to that, then delinquencies will happen for those personal loans that SoFi has assets for. And that would cause a bank run on SoFi because they can't afford to pay the interest rates. But barring some major economic catastrophe because of this event, which I think we can all agree, I don't know if this is a catalyst for like a Lehman in 2008 type of Great Recession crisis, SoFi should be fine because delinquencies shouldn't happen.
So
maybe I
can add just yeah, go ahead, Tannor.
I was just going to say, I also think that eventually, I think the problem is that sometimes with Kris, what I find is like, you can't argue if you just don't believe in the numbers. So I personally do believe in what SoFi is putting out. And then also, whenever you also, look at the rating agencies that are also rating the loans on their balance sheets, it was completely different between SVB and SoFi. SoFi has been rating their ABS markets that they're actually putting out their loans for sale, which is our biggest portion of our actual balance sheet.
And how much do they have to over collateralize to get that A rating?
Yeah, but then so that's a completely different idea. So the idea that it would be AAA rated would mean that we would have the lowest amount of actual discount versus anything else. Like B rated, like triple B loans would have the highest amount of discount. AAA would have much less.
Well,
right?
all I'm saying is there's two things about their FICO scores that that would concern me. All right. Number one, when these loans are issued, that's when your FICO score readings are, because that's what they say at the time of origination. This is the FICO score of the individual, right? Let's say I make $150,000. I fit right into SoFi's profile. I'm good. I pay all my money on time. And then I have a credit event. Let's say I lose my job, right? Do you think my FICO scores matters at that point, whether I can pay that loan back or not?
Well, this matters though if you lose your job, which means the economy has to crash for massive.
And that's right? The point. That's the point that I'm trying to make, that, you know what, we are going to see in the next year, 2 years, how strong the borrowers of SoFi really are. Anyone who took out a personal loan, we'll see. Like I said, I'm not saying that it's definitely going to happen, but if delinquency rates start to go up because people lose their jobs, that's what happens during a recession.
So, okay, I think
sorry, I'm sorry, Tevis, but like, I just don't want you to say something like that. And then okay, so really quick. A credit score only means something because of the history that they have with those numbers. So if the same numbers are considered high rating or super prime numbers for the 2008 crisis, and then Chris Hager has already showed off that chart, so I don't want to show that again. But the idea that some people are getting loans and then at the time that they actually got that loan, they had a high rating and then it recently dropped, is the same thing that would have happened in 2008, right? It's just an arbitrary number. We understand that it can fluctuate, but that's still considered very, good risk to have taken on. So I don't think that it changes at all. There's not a particularly or sign that the people that go with SoFi end up quitting their jobs regularly than any other person that might have a 760 plus FICO score. So you kind of have to look at it the same way that JP Morgan has clients that have over 760 is the same way that SoFi has a client that's 760. Like the delinquencies could stay the same.
I wish The Weeknd named his album FICO Score live at SoFi Stadium 160 and above. That would have been a dope album. Yeah. Okay, Kris, go ahead.
No, I was just going to say, I think we're looking at 2008 and saying, well, you know what, 2008 was fine, so this time is going to be fine also. I don't necessarily think that. Like 2008, Silicon Valley Bank survived. This time they didn't, right? You can't look at the past and say, well, you know what? They did it last time, so this time is going to be just fine. You know, there's a lot of changes. There's a lot of differences between 2008 and now. A lot of people that were underwater in their mortgages and everything else, that was 2008. Right now, their actual assets that people have are really there. There isn't a what's the word? Like a subprime lending event like in the past. In 2008, you had a subprime lending event where people were just putting down, oh, I make $80,000 a year, give me a loan, and people were just getting it. There was no background checks and everything else. This time around, that's not there. But that's not to say that there aren't other factors that are out there that we may not necessarily be seeing. Like, here's the thing: what
about things like capital ratios and these sorts of things that were totally not monitored back in 2008? Like where banks can hold at least 2%, high quality capital in order to, facilitate their loans. Now you look at SoFi and they have over 14% on their books to actually make sure that their personal loans are actually being facilitated. And by the way, the Fed, the OCC, the SEC all have looked at our charts and said, even though you're running personal loans, we'll still keep the minimum at 7%. That's lower than lending clubs, right? So why is it that we get an advantage over Lending Club or some of these other companies still with very similar products, but we're able to hold less on our loans to actually, have a backdrop, and then still we hold more than double that amount? Like, I don't know how SoFi could show you any more than that to say, hey, like, we are playing it safe. We're actually not doing dirty work. Like, of course, we're still growing. We just got a bank. So the amount of loans are going to skyrocket and the delinquencies are going to skyrocket, but we are growing at such a high rate as well.
Yeah, like I said, I'd keep an eye on the delinquency rates. I'm definitely not someone that's going to be an expert in this unless I had like a spreadsheet with all the individuals' names on it, their FICO scores next to it, and then seeing who they are and figuring out, did they lose their job? Did they have their job? Do they, did they change anything in their life? Like, it's not as simple as it was back in 2008 where Burry was able to pull up a bunch of mortgages and then look up the price of the homes that were dropping at the time. Like, that was a whole different story. I think this is going to be something that's been left to be seen. But I'll tell you right now, in a negative economic downturn, SoFi would probably be on like the last of my list in terms of companies that are going to do well. All right. That's all. And right now they're not profitable. The other things, that's the other factor too, right? There are banks right now that are significantly more profitable that are still offering really good rates of return.
They're not net gap profitable, but they are cash. Like, they're not cash burning. We are making money every quarter.
Yeah, guys, I don't know if I can jump in here.
Yeah, just go ahead.
I think we're just conflating a bunch of things. Like, this started out as an SVB thing that can ripple out.
And I want to go back to that.
Yeah, and okay, so a couple of things. I think when dollars shift around in these types of events, there's two reasons that I can think of. One is for opportunity, in which case SoFi's yield would be something that's attractive to people shifting their dollars around. And the other one is fear. Can this bank, remain solvent during tough economic times? And I think that for that, how I'm justifying it in my mind is that I understand delinquency rates can rise, despite, in the Q4 earnings, they basically said it's at 2019 levels, like pre-pandemic levels. It can rise, absolutely. But as delinquency rates rise, they rise across the board and affect every single financial institution. And if I had to make a list of all the financial institutions and put SoFi on that list and, towards the most risky and the safest, with SoFi's metrics where they are in terms of their ratios I would put them towards the more safe aspect, especially considering that their cohort is generally more affluent people that, again, operating from a place of logic, would have more of a buffer financially when times are tough to sustain themselves until they can bounce back with another job. And so I think that if we think of SVB, then I'm viewing it almost similar to FTX to say, what were all of the institutions that were connected to this? Those are the next at risk. But right now, what we're talking about is we're talking about a full economic meltdown that raises the tide of delinquencies across the board for all financial institutions. And just fundamentally, I think that it's opportunity versus risk. It's an attractive return for me to put my money in a safe place, and it's, can this place stay solvent? And I just think that for those reasons that I laid out, SoFi is one of the better options from both an opportunity and a risk perspective.
Going back to Silicon Valley Bank, because that's really what I think is a more fun topic in my opinion.
It's a good topic, but I think everyone in the chat wanted to know the implications for SoFi. So we got the bull side from Tannor in terms of, it's going to be pretty okay. And we got the bear side from Kris. If this causes a real economic crisis, then it would be bad. So
now we're one thing. Can you put up the comment that Eric put up real quick? Because I think that's a very interesting thing. He said, for example, if SoFi had a high concentration of tech workers where their job market has been hit harder than other industries. So this is the kind of theses that would typically get brought up, right? Who are high income workers? Well, tech workers. Where are they? In California. A lot of California tech workers are there. SoFi, I guess, has a large market of people from California. If those tech workers get laid off, if all of these founders, look at right now, SVB, right? They pretty much had a ton of people who are in the founding stages of tech, right? So if they lose out, now they can't pay their employees. Their employees can't make their personal loan payments. You've got higher delinquencies. All I'm saying is watch those delinquencies. The delinquencies are going to be the canary in the coal mine in terms of where SoFi is headed. That's all I'm saying. I'm not saying that they don't have enough capital. All I'm saying is in a hard economic time, you're going to see who's swimming with no pants on. That's all.
To Chris's point, if you bring up slide 4, which is actually kind of interesting, nearly half of all U.S. venture capital-backed startups were involved with the Silicon Valley Bank, per Bloomberg.
Not mine. Good old Bank of America.
88% of Forbes 2022 next billion startups are SVB clients, which is insane. And
Roku had about $478 million of their of exposure to SVB, and Kris, you'll get a kink out of this. Ginkgo had $74 million in SVB.
That's great. And then Circle at the bottom of this little table here, the 25% of their cash reserves were in SVB, and they're the ones controlling USDC, which is the stablecoin for. I don't know any of the implications of what this means at all. But this feels like a black swan for tech, out of nowhere.
Well, I think
of course it is.
When we talk about the actual companies that were linked with SVB, I think one of the interesting points was the FDIC insurance, right? I was reading somewhere that FDIC, one reporting said as much as 90% of all deposits in SVB didn't meet, were higher than what the FDIC cap was of 250,000, meaning that, well, it might be less than 90% in total. That number will be seen, but a very, very large percentage won't be insured. So a lot of these companies that are linked with SVB, obviously that's wildly negative, Riley, right?
So Tevis, they'll eventually get paid. Yeah, they're definitely going to get their money back. The problem is liquidity. The FDIC is going to take all the assets, try to sell them slowly, and give the money back to the creditors. Because now all these people end up on something called a creditor committee, and they're all going to get their money. But the question is, you don't have that money to do other things with. Let's say right now you were about to invest in a building. You were investing in new software. You're not going to do that. You were planning on hiring people. You can't do that. As a founder, you're pretty much stuck at the FDIC level. It's up right now. The biggest the hero of the story is going to be the FDIC and how quickly they move to unfreeze that money and get it back to these other companies so that they can keep their payrolls running. Because if you had significant amount of money in the bank, like right now, if Amit was running his startup, all his money was in SVB. If SVB is right now taken over by FDIC, Amit will get his money, but they'll get it slowly. Now, Amit still has to pay all his bills. He has to pay his AWS. He has to pay his employees. He has to pay all this other stuff. And that's where the contagion rises. That's why I put out a tweet earlier today. I said, I wonder what the exposure to these big tech companies is going to be. Because remember, they all provide services to the smaller tech companies that are still in the founding stages, right?
That was a good point that you brought up, Kris. And then Tannor, we'll get to you. And let's get your take on this, Tannor, as well. This idea that Amazon, Google, Snowflake, they all provide a ton of services to smaller startups, or even, Series C, Series D startups. And if those companies can't make payroll, much less pay for those bills, that might have an impact on earnings, which might be kind of a bit of a catalyst going into Q1 earnings for 2023 for a bad earnings report, at least, not a good one. Tannor, you can speak on that, and then you can go back to the point on SVB.
Yeah, I mean, it is crazy, right? Even though their market cap was quite low, the assets under management here was like 200 something billion. It was the second biggest bank to fail since 2008. I think it was Washington Mutual is what I think I read was the largest bank failure in the United States in terms of assets under management. But whenever we're actually looking at that, you're talking about VCs that are collecting all this money that is being hosted at SVB. They're taking this from, LPs that are also giving this money. They're distributing it to Adia, who's also being told that, keep it in SVB. And then it's this big string of, okay, now no one's allowed to take their money out of this account. You'll get $250,000 by Monday morning. Okay. And then, what does Roku do with $250,000? You know what I mean? Pay an engineer, a single one. You know what I mean? So then we have to actually sell it all out. Hopefully, like Kris said, they'll all get their money. I mean, hopefully, all the goodwill and all of this stuff in terms of the actual name brand of the company are completely gone, right? Even though they kicked Sam Bankman-Fried out of FTX and then they go, okay, well, the withdrawals are back. No one's using that company again. You know what I mean? The actual name brand of Silicon Valley Bank is done for. So there are a lot of things that are being weighed that will be gone forever.
Can you explain I'm sorry. Could you explain? So, as I understand it, there's only a certain amount that's FDIC insured, but you're saying they're going to get all their money back. Is that because, or can you just explain that?
They're a chop shop, right? They're going to take this whole company, see what they own, and sell it off to the highest bidder via auction, and then they're going to pay out like a dividend the proceeds back to all the.
But it definitely won't be enough to cover everything, right? They only.
Well, that's to be left to be seen, right? The problem is
we don't know
if you take all their money and if you take all their assets, right, which is essentially just treasuries, and you put it into the market right now and says, okay, whoever wants to buy it, dude, every buyer is going to say, I want a 50% discount because you have such a huge volume. That's the problem. Now, here's the thing. If they sell it, let's say 5% here, a few percentage here, a few percentage here, then they'll actually get a fair value on the asset itself. If you are trying to sell a whole bunch of assets in a very tight market where right now a lot of people aren't exactly happy with the cash that they're going to ask for huge discounts. And those huge discounts are going to basically mean that all the creditors may not get their full value. That's the other issue also.